The Indian economy grew by just 4.4% in the third quarter, but it has grown much faster in FY22 and FY21 than we originally thought. In the third quarter itself, Capex growth, investment, gross fixed capital formation is strong at 8.3%, but consumption is weak at 2.1%. What more do the numbers tell us about the current quarter and about likely growth in FY24? I have with me four top-notch economists. Ladies first, Sonal Varma of Nomura, Pranjul Bhandari of HSBC, and the gentleman Soumya Ghosh of SBI and Prasanna of ICICI. Ladies and gentlemen, thank you very much for joining me. Sonal, let me start with you. What's this 4.4? Is it a terrible slowdown? We don't like a 4 handle. We want at least a 6 handle. So is this an indication of a serious slowdown?
Not yet, Lata. I wouldn't call it, and I mean, I would not term it a serious slowdown. I think what we basically learn, taking into account the base effects and the past revisions, is that, yes, as you said, post-pandemic, the growth recovery was stronger than we had anticipated. But the momentum right now is surely moderating. I think there are two drivers here. One is the global growth and the spillover onto exports. And two, I think this time around, the slowdown in private consumption is starting to basically become more visible. This is probably because of the high inflation having a negative impact on rural side of demand. But essentially, exports and private consumption are leading to a moderation. On a sequential basis, Lata, I mean, our estimate of GDP in the December quarter is about 1% quarter on quarter. So on an annualized basis, it's actually also running slightly over 4%. So I think going forward, the question is, whether the export engine, the consumption engine, and the investment engine can actually fire up or not. And given the current uncertainty on demand and financial conditions, it does look like the third pillar, which is investment, will suffer. So as of now, it's a growth moderation. The forward-looking view does suggest further decline.
Oh, okay. Yeah, actually, I will come to your FY24 forecasts, and the forecasts are, I think Nomura's, HSBC, Kotak, all of them are running at 5.6 and below that. But Soumya, how strongly should we take this Capex growth, 8.3, that normally improves productivity? Do you think that the coming quarters, we can, bank on this Capex to see faster growth?
Yeah, thank you, Radha. I think as far as the Capex growth is concerned, yes, yesterday's number had come in line with our expectations, but there seems to be some slowdown which is happening if you look into the quarter-on-quarter numbers or the seasonally adjusted numbers. The important point to note here is that the consumption numbers are actually have been much weaker than it was expected. And generally, if you look into the third quarter numbers of consumption and investment, that's always peaks. And this year, a better proxy of consumption is basically quarter on quarter, because if you look into 2%, that also has a base effect involved. Even if you look into the seasonally, the quarter on quarter numbers, that is running at 7% against an average of around 8 to 10% over the last decade. So in my sense, while Capex growth is still holding on, but we can discuss this later, but consumption growth may have already moderated. And just a little bit of addition over here, if you look into the bank credit growth data which came out last evening, I think there has been a significant moderation in the bank credit growth, which is now declined by, I think, from 3.5 trillion monthly in December to around 37,000 crore. And credit to housing sector has now turned negative. So while we should worry about investment a little bit, but maybe worry about consumption a little more, given the fact that the growth seems to be moderating faster than what we are anticipating.
Okay, no, that's important what you're speaking about, credit growth and to the housing sector, because we've just got data that house registrations in Mumbai in February are lower. I mean, it's slow. The pace is slackening considerably. Now, Prasanna, how seriously should we take this? Do you think that this endangers? I think you have a 6% forecast for next year and a 7% for the current year. Most of the others are at less than 7% for the current year and less than 6% for next year. What gives you the confidence that we may still be able to engender 7%?
Yeah, good morning, Lata. I think, frankly, now this year's forecast doesn't matter, right? I mean, the only thing which matters is whether this quarter the economy kind of maintains some momentum and carries forward that momentum into next year. Otherwise, I think the 7%, whether it prints 7, 6.9, 6.8, beyond a point, it doesn't matter. For next year, yeah, I mean, you are right. We are at 6%, but we kind of qualify it by saying there are downside risks. And I think that's already been covered by the others. I think the main downside risk comes from global cycle, basically. But there again, I guess, at least in the early part of the year, we have got some good news from both US and Europe, and even looks like China growth could turn out to be reasonably strong, at least in the first half of this calendar year. So maybe that impending slowdown, which was anticipated globally, maybe that is getting postponed. And that should be a positive for India growth, at least in the first half of our fiscal year. But otherwise, yes, I think and it's also been pointed out that monetary transmission, which is probably still, some of it is still pending in India, that should also be a headwind. So yeah, so I mean, we are at 6%, but clearly we see downside risk, and probably we might end up lower also. But generally, our sense is that looking at this data, especially the revisions, basically, I think economy had been stronger than what we initially thought, and even consumption growth. And especially, I think for this year, I think looking at the quarterly profile also, services recovery has been reasonably good. And we still think that the services recovery from pandemic is incomplete. So basically, that is one reason why we are optimistic about next year. And of course, the other part is the Capex push by the central government. Unfortunately, I think the state governments are not able to kind of match up with that. But assuming if the states are also able to kind of pick up on delivery of Capex going forward, that should be another positive for next year's growth.
In a previous note, Prasanna, you pointed out that even the central government Capex is only because they are adding a lot of the central departments like NHAI into them. So even the central government Capex perhaps is the headline number is looking better than perhaps the internals are. But we'll come to that in a bit. Pranjul, you know, the worrying factor now is that both you and a bunch of you actually are standing at only 6.8% for the current year. That means you are expecting only a 4.4% growth in the current quarter. That is looking a little ominous. I mean, 4.4 for this for Q3, 4.4 for Q4, and you know, about 5.5, 5.6 for next year. Are we so far away from 6%?
Yes, thank you, Lata. Look, you know, I think we are, but let me start with the good news. I think the good news is that right now, growth seems to be far more equitable than it has been in the last year. You know, we finally started seeing some rural recovery. Rural wages are going up. Non-durable production is going up. We are seeing some uptick in informal sector, which had been damaged a lot in the last 2 years. But, you know, with commodity prices coming off a little bit, they are also standing back on their feet. So I think growth is more equitable now than it was in the past. That's the good news. But the bad news is that urban demand, urban consumption, which had been a pillar of our recovery in the last couple of years, has seriously begun to slow. You know, when we look at a host of indicators, for example, the consumer durables in the IIP, you know, all of that has begun to slow. And then we also look at some of the manufacturing inventories. You know, inventories are high. So you have urban demand slowing, you have inventories high, which basically means that manufacturing activity over the next couple of months could actually be much weaker than we are seeing right now. So yes, I do have a fourth quarter forecast of about 4.4%, which is lower than the CSO's implied 5%. And this does show that there could be some sort of, you know, difficulty in the next couple of months. One last thing, I think the next few quarters are very important because we'll know what really happens to the winter wheat crop. If the winter wheat crop is a bad crop, then this rural demand that has begun to rise is going to be a problem. And I think from that perspective, I think the next 3 weeks will give us a better sense on how the next couple of quarters growth will be.
You know, actually, that was going to be my next question, and to Soumya. Soumya, you have the best forecast for FY24. You have a 6.2. Prasanna has 6, and the ladies have closer to 5.5. So, in 6.2, have you factored in the possibility of the Rabi crop being not as good? If that happens, are we in for some, more dreary growth numbers?
No, I think, Lata, that's a fair question in terms of an Rabi crop, and there are already talks in the market of an El Nino phenomenon happening. But if you actually look into India's history since 1950 and the correlation between an El Nino and a possible drought, I think that relationship is tenuous, because it doesn't guarantee that if there is an El Nino, there could be a drought. In fact, there has been periods when the food inflation has been actually lower when the El Nino has happened. So it's too early to take a call on that, assuming that the Rabi crop is not as good as we are expecting. So my sense is that agricultural growth will continue to remain strong, and also the fact that there has been a significant push to the of the government capex. And if you look into the government numbers, I'm leaving aside the states over here. Last year they said they will do 7.5 trillion. The revised estimate, it is saying they will 7.3 trillion. So my sense is that if the uncertainty doesn't escalate the way it looks like now, we will be able to get to a 6% handle or above in the next year, because we are also all expecting that this year the growth could be a meltdown, but ultimately we could be able to hit 6.8 to 7% in the current fiscal. So my sense is that let us wait out for some more incoming data, but at this point of time, a 6% handle looks eminently visible for FY24.
Oh, aapke muh mein ghee shakkar. That's two positives. All El Nino seasons have not led to severe droughts, and we could therefore manage a 6% handle growth in FY24. Soumya says that, although he's a minority at this point in time. We have to take a break, but we're going to discuss the external scenario and the rate scenario in India itself and what impact it can have on growth after this very short break. Welcome back to this very special edition of Indianomics. We have been discussing with Kanti, Ghosh, Pranjul, Bhandari, Prasanna and Sonal Varma the GDP numbers that have been announced for the third quarter and what how growth can pan out in the coming year. Prasanna, I wanted to put the global scenario to you. See, already we know that the US and European continent are not as bad, at least for the moment. But the latest January trade numbers are indicating very good growth in services. I believe there is a lot of global captive centers that have been set up, and that's what is leading to this excellent services number, and that will have a multiplier effect. So do you think, therefore, that we should be, because of the services edge, be able to eke out a better growth in the coming year?
No, I mean, you are right. I think that services, boost to services surplus is clearly showing up on the external account. So I think that is one reason why I think on the street and for us, definitely, I think the expectation on current account has changed quite drastically. So probably at the beginning of the financial year, I think many of the estimates would have been for a current account deficit of around 3.5% of GDP. We are now looking at a full year current account deficit of only 2.2% of GDP. That's a substantial improvement, and a lot of it is because of services and remittances, of course. And we do expect some of this trend to continue going forward into next year also. That said, I think this jump in services surplus which you're seeing, we are just seeing only 2 data points. I think we would still like to be a bit cautious about it. We are not it's not very clear that why this has kind of happened just starting from December. Whether it sustains is something we have to look forward. But But to the extent that what you're saying, if it's right that a lot of global outsourcing or whatever reshoring is happening, I think we still have to keep in mind that the slowdown in US is just delayed. I don't think it's just been postponed. I don't think we can say at this point of time that the US will completely avoid even a mild recession. I think the base case should be that in the second half of this calendar year, US does enter a recession. Because of the extent of rate hikes done by the Fed. Also, I think this quarter US data, I think, is got vitiated by issues with seasonal factors. I think that is something to keep in mind. So maybe data is appearing more stronger than what the underlying reality is. So because of all these reasons, I think second half US growth, global growth, we should expect a slowdown second half of this calendar year. And therefore, that should kind of spill over into Indian exports also.
Okay. Well, actually, a similar question to you as well, Pranjul. January numbers were impressive. We have a current account surplus in January. As Prasanna says, yes, remittances would have accounted for a part of it, but great services growth, and we could see trade, hotels, as you can see, even in the domestic sector, doing well. Can this ameliorate your fears for growth in FY24?
Look, I am excited about services exports, and I think it has really changed in form and shape. We are not a call center anymore. We are not a software services provider only anymore. We've also forayed into design, into R&D. Many multinationals are putting up their GCCs, global capability centers, back in India. Earlier, it was the bigger ones. Now, even some of the mid-sized ones, are coming in terms of, shared sort of solutions like WeWork type of structures in which they take a couple of floors of a building. So I think this is really evolving. And I think this whole business services is going to be something that continues to grow. In fact, some of my basic numbers are that this whole GCC, global capability demand, right now is growing at about 40%, and many engineers who might be losing jobs in tech startups are getting their jobs in GCC centers. So there is something exciting going on, and I'm going to watch out for it. Like Prasanna, I too think that the current account deficit in the next year, next couple of quarters and over FY24 will be back to sustainable levels, 2.5% of GDP or under. So all of this is good news. The only problem is that even 2.5% of GDP current account deficit means that we need to fund $70 billion of a deficit. And I think the worry this time will be more on the capital flows side rather than the current account deficit, which had been the worry last year. How easily will we be able to attract this $70 billion, particularly at a time when we are seeing a lot of the redirection, equity portfolio outflows from India going into North Asia, how long that will sustain, and will the $70 billion be possible? I think that will be the main challenge.
I agree with you that at the moment, at least, the flows are not looking very good at all. But one is hoping that the great Indian diaspora will make up for that by bringing back money to the motherland. Sonal, I want to come to what you're expecting from the Reserve Bank. The cereals inflation is ugly, and fears of El Nino, even if they don't materialize, has already pushed up sentiment higher. So, would you worry that there is another rate hike, only one more rate hike? What does that do to growth?
I think it's very important for monetary policy to be forward-looking now. We have given a significant dose of policy action in a very short period of time. And I think the transmission lags between policy action to growth and from growth to inflation at a minimum are 4 quarters. And therefore, the current growth numbers or sticky inflation numbers do not give us a sense of what tomorrow will look like, because whatever we do on monetary policy today will have a bearing on what the outlook will be 12 months down the line. Now, there are concerns with respect to the sticky core inflation, food inflation, heat wave, El Nino, a lot of concerns to keep in mind, but I think we've reached a point where it's important to assess the impact of what policy has done before taking a call on what needs to be done next. And if we are right on the outlook, Lata, I think we are looking at a fairly significant disappointment on growth. I think it's important to realize that the positive growth surprise in US or China, a lot of that is services driven, which does not really benefit India. It's actually in contact, in-person services. And the higher for longer Fed equates to tighter financial conditions. That's actually bad for Capex. So the positive growth spillovers for India actually are not much from this global backdrop. And we are yet to see the impact of the domestic policy tightening on domestic demand. That is actually something that's going to play out in FY24. So we do feel very confident that growth is quite unlikely to be above 6%, given the current run rate is actually sub 5. And in that environment, I think the risk to continued upside demand side inflation surprise is actually quite limited. Now, it could be a delayed impact on inflation, but it should come.
Okay.
Now, the upside risk is primarily, therefore, coming from certain supply side factors on monsoons, etc., which we need to basically wait and watch. So,
Okay.
our view is it's time to basically pause and take a view on how things actually play out on the macro front.
Oh, yes, sounds very much like an Ashima Goyal, Jayant Varma view, but we'll have to see who wins the debate. Thank you very much, Soumya, Prasanna, Pranjul and Sonal, for enriching our conversation and our understanding of where the economy is headed. The positives appear to be that services sector, even domestically, has still legs to run, and hopefully if this global captive centers brings in more services, exports into India, business into India, that could be a multiplier. Capex could be a multiplier. The government has been at it, but there are serious negatives. Manufacturing already minus 1.1. And if consumption slows, as it appears to be, then we have a problem on our hands. The global slowdown and interest rates can only worsen the situation. Well, thank you very much for watching this special edition of Indianomics.